Well, joining us now to talk more about the cut in China's reserve ratio requirement is Yan Liang, Associate Professor of Economics at Willamette University. Welcome to the show.
Thank you.
So let's start with what cutting the ratio of cash that lenders must have in reserves will actually mean in reality for banks and businesses.
So the reduction in this reserve requirement ratio is basically to cut the cost of banking operations. And because this cutting reserve requirement comes at a sort of has a string attached, which is the financial banks, financial institutions need to lend more to small and medium-sized enterprises, especially private enterprises. So this idea is to give more stimulus, to give more financing to businesses that are struggling, as you just mentioned, especially in terms of the economic slowdown and the looming tough trade negotiations. So a lot of these measures are to provide funding and to provide a boost of confidence in the business community.
Now, we saw that this is coming obviously just as the People's Bank of China just announced measures earlier this week to support financing of small and micro-sized enterprises. What should we read into this particular focus?
Well, so there has been some sort of concern in the private private business community whether the government is going to continue to support, the private economy. So I think this is a very clear gesture that, the government is going to continue to support the private enterprises. Also, China has embarked on this journey of deleveraging and trying to restructure its economy very forcefully since 2016. So this measure is trying to make sure that the financing gets to the right places. So this is not an overall easing in the credit, but rather really to make sure, the small and medium enterprises, private sector enterprises get the financing that is necessary. I think, this is a very timely and I think would be effective measure, not to undo some of the previous efforts to deleverage the economy, to rebalance the economy, but yet, provide enough support for small businesses.
And so which sectors do you see being impacted the most by these policy changes?
So, because of the trade war, there has been a reduction in export growth. So a lot of export manufacturers have seen a dry up in their cash flows. So this kind of measure to reduce their financing cost would help these businesses, manufacturing, exporters, to get a breathing room. And the retail businesses would also benefit from this. As we see from the November number, the retail sales growth have slowed down. And so with more cash injections, more cash flows, this would definitely help that sector as well.
And how can Beijing avoid creating bubbles in certain sectors while it's giving this injection of more liquidity?
Right, that's a great question. So as I mentioned, this reserve requirement cuts is expected to unleash about $800 billion liquidity to the market. And yet, because it's a targeted measure, this financing, this liquidity is targeted towards the small and medium private enterprises. So the hope is that, this money is not going to go into property sector, for example, to inflate the property market. So this measure, coupled with other measures, for example, there's restriction in housing purchases. And so hopefully this would make sure that we're not going to inflate, certain markets, but rather direct this financing to the sector that really need it.
And you mentioned some of the measures that Beijing is taking up so far to shore up the economy. What else are they doing and how are those plans working?
Right, so there has been many different measures. Mostly the government's stance is that they are going to conduct proactive fiscal spending in infrastructure, financing by local government special bonds. For monetary policy, they have taken the measure to be stable and prudent monetary policy, so not to cut interest rates, but rather trying to take an incremental way to cut reserve requirement ratio and more targeted measure to make sure the financing goes to the right place. The other thing that they have done is to allow the Chinese yuan to depreciate about 6%, against the dollar last year. So these are the things that have been implemented. Now, when it comes to the measure, the effect, I think we're still too early to really see the full effect of these policies because most of those policies were implemented in August last year. So we still need to wait to see how it really worked. And I also think that this is a very deliberate, incremental policies. The government does not want to take too drastic, too hasty measures, because that would risk undoing some of the readjustment effects that the government has accomplished.
And just very, just very quickly, because I do want to get to some of the other factors behind China's economic slowdown. We know that the trade war often gets mentioned. Just quickly, what are some of the other factors also behind China's slowdown?
So in addition to this, I think, like I said, this is more of a trend rather than a abrupt slowdown of the economy. So the trade war definitely has some impact. But since 2016, the government has implemented many measures to trying to rein in credit growth, trying to restructure the economy from investment-driven growth to a more consumption-driven economy. So a lot of these policy measures, reining in shadow banking system, would slow down the economy. But these are deliberate policies, trying to restructure the economy at the expense of slower growth. Slower growth, but more quality growth. So I don't think we need to be too pessimistic about this current, slowdown since November last year, but rather see it, in a more positive way, a balanced way.
All right, thank you so much. Yan Liang there, Associate Professor of Economics at Willamette University.